What are the biggest threats to an investor's portfolio these days? Income inequality is stirring nationalistic, protectionist rage, upending democracies and prompting trade wars. Pandemics are shutting down economies and draining local governments of the funds to support workers, communities, and businesses. Risk takers looking for fast returns brought the financial system to near collapse, triggering massive unemployment and government bailouts. Disparities in gender and racial diversity and inclusion are hampering economic growth and fracturing social cohesion. Attempts to preserve fossil fuel jobs are slowing progress toward a low-carbon economy, worsening climate change, which in turn accelerates droughts that then lead to the mass migrations that threaten yet more jobs. These are the 21st century's fundamentally destabilizing, new and different social and environmental challenges. They are global. They have tipping points that once passed cannot be reversed. They are systemic risks in a highly interconnected and complex world, and they threaten long-term investment returns across all asset classes in ways that traditional risk management cannot cope with. Yet conventional investors continue to invest, as usual, ignoring massively destabilizing challenges and giving little thought to the contributions they make to them. Instead, situations get worse as they rack up short-term profits. They view sustainability and environmental, social, and governance, or ESG, factors with suspicion. They believe that they will lose money if they go down that road, and that this way of investing is no more than a passing fad. When it comes to all things social and environmental, if the government hasn't told them not to do it, they can do whatever they please. And anyhow, whatever they do doesn't really change anything. As a result, they declare sustainability and ESG irrelevant. Their primary goal is to maximize returns in as short a time as possible without consideration of such issues. They diversify. They hedge. They look for the next new thing, but they don't see polar ice caps melting and the poor getting poorer and rich richer. They pat themselves on the back thinking they are doing their job. When asked why they don't do anything about systemic crises, they say, "My job is to make money. Someone else needs to deal with the systemic challenges of this world." Sustainable investors have a different take. They recognize the positive social and environmental impacts that specific investments have and intentionally integrate such holdings into their portfolios. They seek ESG benefits along with their financial returns. They invest in an affordable housing project here, a wind power company there. Their portfolios don't include tobacco producers or maybe even coal mining firms. They ask this company to disclose more data on diversity, or that one to improve its safety standards at a supplier overseas. They represent progress. They see the social and environmental challenges in the world and try to keep their portfolios fair and clean. They think allocating assets to strong ESG performers while generating competitive returns is a worthwhile activity. But how can they get beyond fair and clean portfolios to a changed system? How do they propose to make a difference that lasts? While sustainable investment helps investors to manage ESG impacts in their portfolios, it stops short of helping manage systemic challenges. It runs the risk of missing the forest for the trees. In thinking about climate change, a sustainable investor may look at a portfolio of solar power companies and congratulate himself because it is clean. But what if the rest of the world just goes on generating even more greenhouse gas emissions? When asked why he didn't do more, he says, "I did my part. That's all I can do."